Well, good afternoon and welcome, everybody. We're pleased that you took the time to join us, and we look forward to spending some time with you today as we all try to wrap our minds around the rapid news cycle, the ever-changing national and international landscape, and try to make sense of both markets and economic news. I'm excited today to be joined, as always, by our co-presenters, Scott Duba and Eric Kraus. If you've tuned in before to this, you know that both Scott and Eric have a tremendous capability to take very technical and potentially hard to understand information and turn it into something that's both consumable for you, but also practical, that you can walk away and feel like you can apply some of what you've learned to your current situation and to your needs and others' needs around you. Scott Duba is our Chief Investment Officer and Managing Director of Wealth Management. Eric Kraus is our portfolio manager and also oversees our firm's practice in the Northwest Arkansas area. So Scott and Eric, really pleased to have you with us today. And I know we've got a lot of information that we're going to cover. I also know that we frequently get together for this, and we like to share headlines that are reflecting kind of what's happening in the marketplace. And in fact, we typically like to have a little bit of fun with that. But before we do that, I think we would be remiss if we didn't shed some light on something that's not fun for any of us to talk about, but to recognize the atrocities that are occurring in the Middle East. And, you know, as I've thought about this quite a bit, certainly we can see how it has an impact on things from an economic perspective. You may even reference some places where it impacts, you know, the stock market and the performance of the markets. But more than anything, it's a humanitarian issue. And it's real, and it's impacting people who we know directly, people we work with. And so I think that's an appropriate place for us to start. And what I have found, in as much as I'm looking forward to the education I will receive from both of you today, what's happened in the Middle East has given me another opportunity to become much better educated on the Middle East as well. And I feel like I'm learning every moment, and just thought we should open with that by making sure that people understand how significant that is, and I guess, you know, showing that our thoughts are with those who are directly impacted. As I mentioned before, we do like to have some fun with our headlines, and I think that, you know, on the one hand, seeing something serious going on in the Middle East like we have helps us to understand that a lot of what we see in our day-to-day lives here is pretty trivial. And speaking of trivial, this is trivial, but it's dominating headlines throughout the United States, and we're a Kansas City headquartered company. And so the fact that who Travis Kelce is dating, and the fact that it's the biggest superstar in the entire world, and that we all know who Donna Kelce is now, tells us that we've got a lot of trivial events that happen to us on a day-to-day basis. But we also know, and you guys may speak to this, that Taylor Swift concerts across the United States and elsewhere within the world are driving consumer behavior, are impacting the degree to which our Federal Reserve thinks about what interest rate policy might be. So it seems trivial, but it's also pretty fascinating. And so, you know, I thought as we got ready today to really set the table for us. So, you know, we understand here that the Federal Reserve is trying to get to a point where they say, hey, we've got our arms around this. We've got this figured out. When can we finally see data reflecting that the Fed has done what we need the Fed to do? But ultimately, as the data continues to tell us, and I think the two of you might speak to this, we're probably not entirely out of the woods yet, are we? So if you can help us to understand that a little bit, gentlemen, and maybe the starting point here, Scott Duba, I'll have you start us. You know, how's this year's performance compared to prior years?
Sure, Matthew. Thank you for hosting, and thanks for the invite. Always happy to join and talk through these issues. So year-to-date performance, I'd say it's kind of a tale of two markets. The equity side of the market has been frankly pretty normal, with year-to-date returns a little bit better than average in the low double-digit range, coming off a pretty painful 2022. But on the bond fixed income side of the world, it's been a lot more muted, frankly, with, again, bond markets under pressure for the third year in a row, which is unique. And so from a year-to-date basis on the equity markets, if you pull up the chart that shows kind of the historicals, We're up about 12% year to date, which, as you can see in the chart, is kind of the midpoint of what we've seen historically. We always have intra-year declines, and this year we had an 8% drawdown before getting to 12% year to date. And coming off of down 19% last year, our clients in our portfolios have clawed back a good portion, but not all of the pain that we felt last year. If we flip to the fixed income market, this is a bit more consistent, at least for the past few decades. We've had fairly beneficial interest rate and inflation environment over the past few decades. And so we've had a very consistent run of positive portfolio returns in the fixed income land until the past couple of years, where, as we all know, as inflation has ticked up and the Fed has had to be more restrictive on monetary policy, that's obviously impacted where bonds trade and the total return that you've gotten out of your portfolio. So year to date, while equities are up nicely, bonds are down 1%, which for our clients that generally have a balanced portfolio, typically around the 60-40 benchmark, year to date, it shows the power of diversification. Matthew, if you flip to the next slide, year to date, we're just shy of 7%, right around 7%. The green boxes being the equity market contribution and the gray being the fixed income contribution. So again, you've had two different markets, equities up, bonds down, but overall, if you have a balanced portfolio, you're making good progress towards your financial goals.
Now, Eric, I know you spent a lot of time in a difficult 2022 speaking with investors and retirement plan participants about, a tough market, both in bonds as well as stocks. How have your conversations changed this year when you speak about how the market's performing?
Well, certainly it's good to see some positive numbers, right? A little bit of recovery goes a long way in helping sentiment, investor sentiment, the willingness to stick with a long-term approach. But while I would agree with Scott that the numbers on the page do look run-of-the-mill, almost normal for equity markets and fixed income, it has been disappointing. If we dive in even to our next section here, where we talk about what's been driving the markets, it's been, use the term kind of tale of two markets to a degree. I would say that's even nuanced within the equity markets. And that the concentration in the top 10 stocks in the index in the S&P 500 is near an all-time high, representing nearly a third of that market capitalization. And so what's worked have been those high growth companies, some of the companies that struggled last year, but also some of the companies that truly have maybe a secular growth story, like AI behind them, so semiconductor software companies. But what's been interesting when we look at the equity market returns, that S&P 500 return is great. And a lot of our clients have been able to have some exposure there, of course. That's the largest holding in a lot of our portfolios is just an S&P 500 index. But I looked up some returns earlier today just for some comparison's sake. And again, I think there's this misconception that when you own that S&P 500 that you're not trying to make individual investment decisions. That's the whole point of being passive and owning an index. But that concentration, as I mentioned, that 33% in the top 10 holdings, if you would just take that S&P 500 index and divide that pie into 500 equal slices and invest an equal share into each of those 500 components, the return on that index is actually only up around 2% for the year. So the average stock is only up around 2%. And similarly with small caps represented by the Russell 2000, that index is up a little bit less than 2%. The Dow's up 3.5%. So while it is good that we see those headline numbers, as we dive into the weeds a little bit there, we see that some of those sectors have underperformed. And Matthew, if you'll flip forward to the extremely detailed slide, which I promise not to spend too much time on, just one more, please. That next slide there shows the sector returns across the 11 S&P 500 sectors. And 5 out of those 11 sectors this year are actually in negative territory. Now, some of those sort of make sense. One of the drivers, which we'll get into, is rising interest rates. Some of these are very rate sensitive, meaning they tend to underperform when interest rates are going up, like real estate and utilities. But also some of these are more conservative sectors, consumer staples, utilities. You typically roll the recession playbook out, which is what everyone was calling for this year. And if that was your playbook, unfortunately, you've rather significantly underperformed the broader marketplace. But anyway, Scott, I'm not sure if you have any other comments on that, just how difficult it's been from a portfolio diversification standpoint, but also just recognizing what the average investor is up against there.
No, I think that's well said, Eric. It's been very unique in terms of the concentration, especially in large cap growth. The only real good analog would be the dot-com era of the late 90s when we saw similar levels of concentration. over the past couple of months, as the market's pulled back a little bit, we've seen a little bit more normalization, but it certainly has been a less broad rally year to date than normally what we'd expect.
So is it a good thing or a bad thing when the market is up 10%, but we say a lot of that is due to heavy concentration? How should people interpret that information?
I would say typically in a more healthy market, you would expect broad economic health and conducive growth conditions to benefit all sectors. I'd say the uniqueness of the monetary policy backdrop and the rise in rates explains somewhat the bifurcation in performance by sector. So I'd hesitate to call it healthy or unhealthy. It's just less broad-based, less of a conviction rally than if you're coming out of a recession where the business cycle is really sort of starting to take off, where you'd expect to see higher, more broad performance across sectors, where I think we're just in a unique environment where we've had a very rapid and significant rise in the cost of funding, and that impacts different sectors differently. And we're kind of real time, this year, in the past 12 months, companies are working through this, finding out how that impacts their cost of capital, their wages, their inputs, and how much they can pass on to consumers. So it's a bit different than what we normally see, and I think it's not surprising in the context of the broader macro environment in which it's occurring.
Eric, as you know, I work a lot in the retirement plan context, and there's so much focus in the retirement plan context around fees, and this notion that there's a bit of a race to zero. And so what's come of that is, I think, probably perhaps an overdependence on passive investment. And so there's been this sense for plan fiduciaries that, without regard to what might be best for participants, just the safest way for them to stay out of trouble is to move to something passive, low cost and passive. I wonder if you can comment a little bit here, though, on this middle. There's 6 big grids on here. The one in the middle top, which reflects the big difference between the left side of the style box, as we say, and the right. Maybe you can speak to some of the complexity involved in true diversification.
Yeah, absolutely. I think that box that you're highlighting right there, that just the huge disparity between large cap growth up 25% and small cap value down 0.5%. It's not enough just to say I own equities and I own bonds and I'm diversified. It's not even enough to say I own large cap equities versus small cap equities, because you can see again the difference between value and growth there. So we do think that indexes are an incredible building block for portfolios. We use a lot of index funds, a lot of our strategies. But it's, again, if you're kind of following along with current events and you want to be responsive, or not even just responsive, but hopefully proactive, right, in our portfolio decision-making process, so we can be prepared for what's next. It's certainly, you have to be sometimes a bit more nuanced than what just owning the broad index will allow you to do.
But it kind of feels like there's a pendulum that swings from left to right here a little bit to that degree. And so we've seen, in recent years, these bigger spreads between the left side and the right side. And as I think a lot about retirement plan participants who will be getting statements, now, or statements at the end of the year, those who are in a target date fund strategy or some sort of model portfolio or managed account strategy, they're having these nuances managed for them. But, for those who are still out kind of picking and choosing their own investment options, a lot of times they end up chasing returns as a result of this. And as that pendulum swings, we know that it's a fool's errand to try to time the market just perfectly, but they're almost always behind the pendulum when that happens. And so I think Eric and Scott, that's something we'll want to keep an eye on as we look at, investor behavior here over the next several months. So you got in this a little bit, not only like which sectors are experiencing positive performance and those that are, experiencing negative performance, but maybe if you could dive in a little bit more to like what's really driving that disparity, like what's driving the positive performance where we see it, and perhaps maybe we even start with like what's driving the troubles. Why are we experiencing negative performance in some of those areas that may have seemed inexplicable, but I think perhaps there are some explanations that you can help us with.
Sure. So I would say the general story for the first half of the year through the second quarter largely centered around excitement around AI, especially in the large cap growth sector, as well as a recovery from some of the pessimism, the pervasive pessimism we saw in the markets in Q4. So the markets performed very strongly through the first half of the year to about the end of Q2. And then as we got into July, August, the Federal Reserve, which was in real time looking at the data on inflation, they started to come out with a bit more of a hawkish tone and really leaned into convincing the market of this notion that rates are going to stay higher for longer. And what the Federal Reserve does quarterly when they meet is they'll put out their projections of what they expect from various economic indicators, one of which being how they see short-term rates progressing over the next 12, 18, 24 months. And for the past several quarters, we've seen a pretty consistent disconnect between what the Fed would suggest in its projections short-term rates will be at in 2024 versus what the market is pricing in via options on short-term rates. And what's really sort of driven the market weakness over the past, say, 2 months or 3 months really, has been this more emphatic tone from the Fed that they still see work to be done to get inflation lower, and that they expect to keep rates higher than, or rather longer than the market may have been expecting in the first half. I think we have a slide that alludes to this somewhat. Yeah, so the darker blue diamond would be the Fed projections from where they expect to see rates in, say, middle of 24 at 5.1%, whereas the market is thinking more like 4.6, 4.7 at the same point. So basically, the market is thinking the Fed's going to have to cut sooner, or they're not going to be as hawkish or follow through on what they're saying. And this tone from the Fed, this emphatic reinforcement of the notion that they need to see inflation getting down to 2%, that's really kind of caused a pause in the market, and it's caused a backup in a lot of interest rates, which impact valuation overall. And so I'd say that's been what's driving the market. First half, mostly AI recovery from bad sentiment, and Q3 has been this sort of digestion of a more hawkish tone from the Fed.
Yeah, I'd agree with that. Matthew, if you actually drop all the way down to that yield curve slide, I always get warned that this slide is not that interesting to the average person as it is to me. But it's a great visual, in my opinion, to further drive home Scott's point is what's happened with interest rates. So 3 lines across the page here. The gray line represents where interest rates were on 3-month up to 30-year treasuries back in 2021 before all this started, before this rate hiking cycle started. Then that green line represents where we landed at the end of the year. And I think many people were forecasting a few more rate hikes on the very short end of the curve, so that 3-month treasury bill at the beginning of the year. But the market wasn't really expecting that narrative that they've delivered more recently of that, hey, we're going to hold these rates here for a while. We may stop soon, but they're here to stay. So that adjustment upward of interest rates, particularly on the 10-year treasury, is one that a lot of people follow. That spiked almost up to 5% just last week. And that's had a very immediate impact on bond prices. That's why we have a negative bond market return. But that fear, again, that cost of capital and what lagged effect that may have on economic data, that's what's caused at least our short-term pullback here. And we'll see if markets can fully digest that and move forward and hopefully have a nice rally into the end of the year, right? I don't think there's anybody out there that's rooting for a negative market return. And it is quite reasonable to expect that we have a seasonal pullback after such a start to the year. So it's not atypical to see maybe a month of August and September weakness, sort of some consolidation to keep valuations in check. But that yield curve or interest rates, I agree 100%, has been top of the market's mind almost exclusively here for the last couple of months.
One of the easiest things for people to see on this chart, obviously, is the numbers, right? And we can see a significant jump in the numbers from the gray to the green and then again to the blue. But I want to ask you to address something that's a little bit more nuanced, but perhaps just as significant. And we might call that the shape of the curve. So I think it makes sense to a lot of us, right, that if we're going to tie up our money for a little bit longer, then we'd get a higher interest rate on that. It makes sense, just in general terms. So how do we find ourselves in a situation, Eric, where we've got these higher interest rates on the shorter end or the nearer term end of the curve? Like, what really causes that to happen? And then what does that mean to the marketplace and ultimately to people who are listening today?
Well, that's a great question. And you probably, if you read headlines, you hear about an inverted yield curve and how significant of a recession indicator that's been historically. And it's a dangerous thing to suggest that this time may be different. So that's why there's still a lot of predictions for recession out there. But the Federal Reserve, all they can control is that very short-term rate. When we talk about raising interest rates, they don't go out and raise the 10-year Treasury rate. They raise that very short end of the curve, and then the market responds to what it predicts in the future. And some of that is just a willingness to say, hey, look, if I can get 4.6% and I can lock that in for 10 years, that's better than I've had in the last 15. So there's an appetite for some of that, particularly among institutions. But oftentimes what you're seeing, it's an inverted yield curve, just reflects future expectations for lower growth or lower inflation, and the fact that the Federal Reserve will ultimately be cutting those short-term rates. So it's kind of like locking in your rate for longer, if you will, with your cable company. It's like, hey, give me that short introductory rate. Let me lock that in for a longer period of time. I'm maybe willing to accept something that's not quite as favorable as a short-term discount for that longer period.
Now, Scott Duva,
Matthew, maybe one thing just to touch on is the impact of the federal balance sheet on this discussion. While the Fed influences short-term rates, it's more so the appetite of institutional investors and sovereign investors to buy long-term treasuries. And I'm sure our clients have noticed this in the press, but there's been a bit more focus, a bit more concern around the overall health of the U.S. balance sheet. This slide is a bit busy, but I direct your attention to the bottom right-hand corner, which is federal net debt relative to GDP. And the simple stat is debt to GDP was at about 100% at the end of World War II, and it trended down for about 5-6 decades, and then started growing, especially after the Great Recession in 2008. And it has continued to grow really to date as a function of the Fed having stimulative monetary policy coming out of the COVID recession. And that has not been an issue historically so long as inflation has stayed low. But now that the Fed has had to increase interest rates, that has caused the cost of debt for the Fed as they refinance existing maturities to start to go up. And if you look at the bar chart on the left-hand side of the page, the furthest left column is total spending. It's $6.2 trillion. About 10% of that is net interest. And as with any financing, whether it be a home, a car, a business, those maturities come due. And as interest rates have risen, as the Fed refinances this debt, about a third or a quarter of it each year, that net interest burden on the federal deficit will go up. And that has caused investors, both foreign and international, to demand, to some extent, a higher interest rate on what they will buy that new debt at from the Fed. And so while the Federal Reserve, or I'm sorry, I should be saying Treasury, while the Federal Reserve impacts short-term rates, it's this Treasury issue, this U.S. sort of budget concern that is also to some extent impacting those longer-term rates. And so it's this combination of factors, this inflation fighting, the Fed raising short-term interest rates, the implications that has for the overall balance sheet has really sort of driven this across the yield curve move up in rates, which is obviously impacting all sectors of the economy.
Eric, we started looking at, this type of information that Scott's just addressed, a decade ago in great detail. And I think we've kind of tracked this over the last decade as spending continued to increase at the federal level, whether it was a Republican or a Democrat in the White House, whether it was a Republican or Democrats controlling Congress, it seemed like spending just has really taken off over the last decade or two. And I think you probably heard me ask, but does it matter? I mean, does it feel like we could just, kick the can down the road into perpetuity? And it felt like a few years ago, the answer might be yes. But, how do you feel about that question now? Do you think this can just continue forever, or perhaps Scott's given us some insight as to why it does matter?
I think Scott's spot on. I think it's happening right now. That's why there's been a very large amount of issuance in the last 60 days, and it hasn't been received quite as warmly as it has in the past. And some of that's, obviously there's some political division that we're all aware of, acutely aware of, right? That there's some debates as to who's actually going to solve this problem. Is it going to be through spending cuts or increases in revenue? How are we going to address this issue? And to Scott's point, the issue compounds itself. We all know that compound interest is the eighth miracle of the world, and unfortunately it works against you when that compound interest is debt. with all the refinancing that has to be done. So we'll see. I do think that the market, the term bond vigilante came out many years ago of people who said, hey, look, we're not going to accept this level of spending and your rates are going to be higher. I hadn't heard it in quite some time, but I've heard it surfacing here again, and we're starting to see the impact of that with higher interest rates and those longer end treasuries just here recently.
Scott, when you look at valuations, I think you've got some thoughts on why there might be maybe some slightly even better, if not optimistic news buried in the valuation.
Yeah, absolutely. I would say, if you recall what we led with, the bond market for the prior 2 years and year to date has had a negative total return. That's pain that's been felt in portfolios. The upshot of that, though, is that we now have pretty compelling valuations in the fixed income world. This slide, each column represents effectively an asset class. And on the left, those columns represent treasuries, muni bonds, and U.S. core bonds. The green dots are where these valuations sat relative to their 25-year averages at the end of 2021. And the gray circles represent where they are now. And you can see across the curve, everything looks better, but the equity world still looks a little bit expensive relative to historicals, whereas in the fixed income end of the curve, treasuries, munis, U.S. core bonds, they're about one standard deviation away from the long-term averages. So, while the portfolios have felt the mark-to-market impact, the yields that you can get in fixed income securities at very low risks are quite compelling, especially for retirees or clients that are less comfortable taking risk. And so it shouldn't be lost that in any sort of pullback or any sort of market turmoil, there's always opportunity. And I would say the fixed income market today is a good example of that.
Okay, so we've talked here about the significant changes in interest rates. It feels like we are indeed starting to see an impact on the market, but why hasn't that impact been more obvious and more significant to this point in time? Why aren't we really quite feeling it to the same degree that perhaps we could be?
I'll take a quick run at that first, I guess, and then we can talk about.
I just want everybody for the record to recognize that talk about interest rates does bring out the smiles from Eric. And so, Eric, we'll let you joyfully jump into answering this question.
Perfect. Thank you so much. I appreciate the opportunity. I won't make any references to the fact that you don't have any daughters and still somehow pulled out that Taylor Swift art to start the slideshow today. No big deal. That's great. So why haven't rates had a bigger impact already? I think a lot of this has to do with the fact that the labor market remains incredibly strong. So interest rates do have an impact on everything that we do from a purchase decision. So whether it's a car, if it's credit card debt, student loans are kicking back on, there's all these things that interest rates will impact. But the labor markets remain incredibly strong. We have unemployment still at historically low levels, and wage growth, while it is coming down, that's a good thing for inflation, right? That's sort of the objective, is to get wages under control so we have this more sustainable path. But people's wages have not, certainly I wouldn't assert that they've kept up with inflation. I think that would be very out of touch when we realize that prices are 20% higher than they were a few years ago, and it sure doesn't feel that way for wages. But the reality is people have been able to kind of keep spending through this to a degree. The consumers remain incredibly strong, whether that's through the pandemic stimulus that's maybe starting to peter out, but has been present with us. But that's in my opinion what's kept us from seeing a larger impact of an economic slowdown thus far.
So as we look at some information to answer that question, we do know that down here on the lower right-hand corner, we're starting to see some interesting information though regarding early delinquencies when it comes to credit. And I wonder if one of you would kind of talk us through some of that information.
Sure, I'll take a stab at that. If you look at the bottom right-hand line graph, the blue is auto loans, the gray is credit card debt, and the green is student loans. And you can see, well, let's take the green first for obvious reasons. The student loan repayment deferral program obviously led to a collapse of any delinquencies because there's no payments need to be made. But if I draw your attention to auto and credit, you can see that those delinquency rates are starting to peak back up. Now, that's somewhat expected given that they had been sort of depressed coming out of the COVID recession. And also when you think about the more onerous terms to refinance when rates are higher, if you're trying to refinance an auto loan or a credit card loan, maybe you're refinancing cheap debt, you got to refinance more expensive debt. The issuers of that debt are going to be a little bit more picky, and so your delinquencies will pick up naturally. So to Eric's point that we're starting to see some pressure on the consumer, I'd say this would corroborate that take. But I would also point out that if you look longer term, these delinquency rates are still at pretty reasonable levels. They're about where they were for the decade from 2010 to 2020. And so it's really been more of just a return to normal, so to speak, as opposed to what we saw in the Great Recession of 2007, 2008, 2009, where things got very stretched very quickly. So it's something we're keeping an eye on, but it's somewhat expected based on what the Fed is doing with rates and trying to slow the economy. But I wouldn't say it's necessarily a cause for alarm at these levels.
Yeah, we also talked about, just really quickly, Matthew, as it relates to housing in particular. So adjustable rate mortgages are very uncommon, even relative to where they were during the Great Financial Crisis. So in order for the Federal Reserve to slow down the housing market, it's just they're putting a very high amount of pressure on a very small segment of the market, which is the market that's moving. And you think about all the people that took out a mortgage or refinanced a mortgage in the last 5 years at a rate at 3% or lower. Well, they're not really experiencing a housing cost increase, right? Because their mortgage payment is the same. Maybe they have higher property taxes, especially living in Kansas City. I know it's a hot button issue if you live in Jackson County. But the actual mortgage cost is the same. That's the beauty of a 30-year fixed mortgage. And it has slowed down some of the velocity of transactions in the real estate market. A lot of people are just kind of sitting on the home that they have. But what that's caused, miraculously, you wouldn't expect home builders to be doing quite so well as one of the top performing sectors in the stock market, maybe up until more recently, just because they're the only people that can build and create new inventory. And there's still a significant imbalance of supply and demand. So even though the Fed typically raising interest rates would have a direct impact on slowing down housing prices and housing inflation, unfortunately, it's almost worked against itself to a degree by creating more friction for people to move and boost that inventory level.
Yeah, I think one other pretty fascinating data point within the materials here is on this kind of the graph here on the left of this slide. And if you're a retirement plan committee member or a trustee and you meet with us, you've seen this information from us recently. We think it's pretty relevant whether you're an individual investor, you're a retirement plan participant, or you're a retirement plan fiduciary, to recognize that savings rates are at a level that will not be sustainable for our country moving forward. And if you look at that chart over there on the left, you can see that savings rates really started to fall off in the 90s and the early 2000s. And that was happening in a bad time because that was when companies were moving away from traditional defined benefit pension plans. So that was a point in time where we wanted to see savings rates increase rather than decrease. Now, perhaps from some of the benefits of the Pension Protection Act of 2006, which made automatic enrollment, automatic escalation a little bit more popular, we start to see a spike or an increase in savings rates. We did see a spike during the pandemic, but as we know, that spike was not due to Americans suddenly deciding they wanted to save at a significantly higher rate. It was more of a product of the fact they couldn't spend the way they wanted to. Well, now that the supply chain is loosened up and the travel channels have opened back up, we can see we're at this point where about 4.2% as an annual savings rate. What does this mean to all of you who are listening? Well, if you're an individual, ask yourself, how am I doing relative to the national average? If you're on this webinar, you're probably well above the national average. If you're not, see what you can do to get there. If you're a retirement plan fiduciary, you're listening to this, let's look at your data on your plan at our upcoming meeting and say, hey, how does our population compare to this? And I think most of you will be pleasantly surprised that the things that you're doing within the workplace to help your people out is getting your employees at a level that across the nation we're not experiencing. So kudos to those of you who are doing that, because as you can see here, people are going to need help. And I wanted to address that very quickly because we're talking here about consumer spending, we're talking about debt load, we're talking about delinquencies. And certainly as people find themselves delinquent on debt, they're unlikely to be saving more at the same time. So I think that's the interrelation of all those. All right, so as we opened our conversation earlier, talking about, being out of the woods, I think it is really relevant for the two of you to share your thoughts. Like, are we past all the inflation? Is that going to be something behind us and that we won't experience that? Or will we experience it at a slowing rate? What are your expectations as we move forward?
Well, I've got to give Scott credit here because I think a year ago when we ran this webinar, he said he thought the easy work would be getting inflation from 9 down to say 4 or 5%. But it'd be far more difficult to achieve the Fed's long-term target of 2%. And I think that next slide really illustrates that in the report that we saw this morning. Scott, if you want to kind of take it away and give us your insights there.
Yeah, sure. Thanks, Eric. This chart's a bit busy, so I'll try to simplify it. On the left, you have headline CPI inflation, which includes food and energy. On the right, you have core services ex CPI inflation. So let's focus on the one on the left. When we were at peak CPI readings in the middle of 2022, a lot of that was coming from energy. We all know kind of how energy prices spiked up with the geopolitical issues in Eastern Europe. And as those have abated and those comparisons year over year have gotten easier, even though some of the other colored bars on this chart have stayed kind of consistent, the energy sector was less of a headwind. So we had this nice sort of smooth trend from 8-9% down to 4 or 5%. And then over the past, few months, that energy comparison has actually gotten a little bit more positive, where we're coming off really high energy prices a year ago, whereas now they're actually lower year over year. And that pulled down headline CPI inflation to a low of about 3% in June. What we've seen, though, over the past few months is that some of these other segments of the inflation math, food, restaurant, hotels and transportation, shelter especially, they've stayed pretty inflated. And so in the past few months, we've seen this headline inflation number kind of perk back up to the high 3 level. Even the reading today, we came in a bit hot. And so you've had this dynamic where you kind of did the easy work, getting it from 9 down to 3 or 4, but the Fed is still very adamant that they want to see it at 2. And so it's this push and pull between an independent central bank that's trying to get inflation down to 2% versus a broader economy, a broader U.S. population and government that would prefer not to have so onerous of cost of money. And so I think this is kind of the fight we're seeing kind of in the markets right now, is Fed trying to enforce this discipline to keep low inflation, keep inflation expectations anchored long term, and trying to get the market to believe that they're going to do what they need to do to get it down to 2%. So to take our woods analogy a bit too far, it's as if you walk through a relatively easy path to the edge of the forest. Now you got to get through the bushes, the prickly bushes at the edge to actually get out of the forest, or the woods, sorry. So I'd say we're not quite out of the woods yet. We got to climb through some prickly bushes, but we'll get there, because I think the Fed is on the right track to kind of get that where it needs to go.
So as we think about, it's still the tough path ahead, we have this question, and it's a bit of an evergreen question, sticking with the trees forest theme. And I ask you, are we going into a recession? And then I want you to follow up your answer by answering this question: does it really matter if we find ourselves technically in a recession? Eric, why don't you jump on that one first?
Yeah, I think we want to make sure we don't, or we see the forest through the trees, whatever. Keep going there with that analogy. Does it matter economically? Of course it does matter. If we enter a deep recession, that's when you see job loss. That's when you see companies shut their doors, people lose their house. That's what we all kind of envision when we go through a deep recession. There's not a whole lot of forecasts out there for deep recession besides the people that are selling gold at this point, and maybe some of the people that are more on the fringes of the analyst community. But on the next page, you'll see that the consensus is still calling for a chance of a recession in the next 12 months, over 55% probability forecast. And I think I started a lot of presentations early in the year poking fun at economists, calling them kind of like meteorologists with their percentage chances of rain. And So far this year, it's been overly negative, the prediction from economists. The economy has been incredibly resilient. And as for all the reasons we've talked about, the strength in the labor market, the additional spending that's come through. But I do think from an investor perspective, we want to be mindful of that the market is not necessarily, again, that temperature reading what's happening today. It's predicting what might happen on the other side of whether GDP technically turns negative for 2 quarters or not. It's trying to identify our companies valued fairly based upon their future earnings growth. And earnings growth is projected to pick back up. We'll get a better sampling of that here in the next couple of weeks as we enter earnings reporting season. But I did have one slide that I wanted to show on the next page here that I think is really interesting, because for investors, it's uncomfortable right now. Everybody hates inflation. And the inflation picture doesn't feel better when inflation just gets down even to 2 or 3%, because we've already been through the pain of the price hikes. And consumers are sort of anchored to what prices used to be and what it used to cost to do things. And it's going to take some time for people to process through that. So we've had a lot of investors, especially what we've been through the last couple of years. It's been a long and painful ride since 2021. Whether you're a stock investor or a bond investor, the S&P is still 12, 15% below its all-time highs. So we get the question more frequently than I've ever had in my career is, well, should I just buy some CDs? We can make 5.5% without any risk. And the short answer is probably so with some of your money. So money you have parked just in a savings account that's not earning you anything, that you don't need immediate access to. But I think it's also a little bit of a red herring, or at least maybe a trap that we can avoid, of thinking that that's a long-term investment strategy. And JP Morgan put this chart together this quarter. I think it's really fantastic. What it shows is the history of the last several rate hiking cycles. And when you get to that peak CD rate, so when CD rates are very much directly correlated with what the Fed sets as interest rate policy. They're very responsive to short-term interest rates. And what these gray bars represent, the little dot at the top, the diamond, represents the 6-month peak CD rate. And what this chart is illustrating is what your investment alternatives would have been for the next 12 months if you'd stayed the course with a more diversified portfolio allocation. And we've talked kind of at length about bonds and how weird it is that they're down 3 years in a row, and perhaps the opportunities there from a valuation perspective. But that dark blue line represents that idea. If interest rates do go back down, even by just 1%, the 10-year treasury drops by 1%, you should likely have a double-digit return in bonds whenever that does occur for that next 12-month period. But even equities, I mean, there's exceptions to this, and you want to be careful about saying it was a great time to invest in equities in 2006, before 2008. So sometimes charts can show you what they want to show you. But over the long term, if you're a long-term investor, knowing that those rates, even though the Fed says higher for longer, that could just mean 12 months from now or 9 months from now before those rates become fleeting. And we'll want to make sure that we stick with a diversified investment portfolio to achieve our long-term goals.
So to wrap up our comments, Scott, is there anything else from your perspective, either as our chief investment officer or when it comes to wealth management, that would kind of dovetail onto the end of what Eric said, or any thoughts that you want people to really take away from our conversation today?
I think Eric said it quite well. I think there's an allure to the short-term risk-free rates in CDs and money markets, but there's also an opportunity cost to being misallocated from a strategic perspective. And it's really those times when there's churn and trop in the market, when sticking to a strategic asset allocation and being present for these recoveries once rates ultimately start to normalize and come down. That's really when you kind of drive the performance from the risk buckets within your portfolio. And I would say now that we're more than 18 months into the hiking cycle and we're starting to see some of the implications of that, I think this chart is relevant, because I'd say we're much closer to the peak of CD rates than the trough. And so I think it's important to stick to a strategic asset allocation. And Matthew, since you get to ask all the questions, I'll leave you with one. If a tree falls in the forest and no one's around to hear it, does it make a sound?
Well, or like I always say, if I speak and my wife's not in the room, am I still wrong? Which I think is a similar question. So in closing, just a few comments for everybody, and we've got some upcoming webinars here. If you pull out your phone, use the QR code to be able to register for one of these upcoming webinars that we have. I'd just like to share a couple of sentiments with you. Number one, thank you again for joining us today. Thank you for taking 45 minutes out of your day and your routine to be here. And thank you to Scott and Eric for all of your comments. And the second thing is, you know, whether we're talking about the atrocities in the Middle East, or we think about, you know, student loan debt and the burden that that poses on people, or trouble to get affordable shelter, et cetera, it's just a reminder, I think, to each and every one of us that, you know, the world is so much bigger than us as individuals. And so as we carry this forward and you think about what do you do with the information that you gained today, I hope that you'll take it and apply it to your own financial situation. I hope that you'll be able to help to kind of reaffirm your plan and stick to your plan as you move forward. But I'd also urge you to figure out a way to take this to get out and impact somebody else more broadly and outside of yourself, because I think this just serves as a really key reminder of just how big the world is and what a small part we are as individuals. So again, thank you everybody for joining us. Scott, Eric, thanks so much for all your commentary. If we can help any of you in any way, please don't hesitate to reach out, and we wish you all the best rest of the week. Thanks so much.
Thank you.